Hello and welcome to Todd Miller TV, your resource for what's current in the Las Vegas real estate market. And I got a response from one of the videos from an investor who wanted to know why Nevada. Why should I invest in Las Vegas? Because I can pick, Florida, Texas, California, Nevada, all these other places to invest. And that's actually a good question. Why? So, what I would kind of like to do is put a whole bunch of videos together, maybe one a week or so, just for investors, and sort of give you an idea of what some of the potential opportunities are. I'm going to start right now with something very general, just to tell you what's going on in Las Vegas. As you're probably aware, we lead the nation in unemployment, about 15%. Now, the numbers can be misleading because we do have a lot of people who are being counted in those numbers, who are, worked in the casinos, worked in the hospitality industry, and that's taken a big hit. A lot of construction people too, people who were building the high rises and houses and things like that, are counted into that number. And why that's a little misleading is because what it shows is we have a couple big sectors that got hit, not really overall. For the most part, if you go to businesses, you'll still see businesses are hiring, and they're bringing on new people. We have new business coming to town. The concern it raises for an investor having high unemployment is, what does that do to rents? Well, what it tends to do to rents is it tends to lower rents because people have less money to pay. People tend to lose their houses. More investors come in and buy houses, and then you have a greater supply of investment homes. Historically, in Las Vegas, rents have increased very little, 1 or 2% a year. Basically, rents have historically followed inflation. Now, you remember about 4 or 5 years ago, prices shot up 50%. Well, rents didn't. Rents still barely crawled. And that perplexed a lot of people. They said, hey, wait a minute. If values are, I'm having to pay twice as much for a house as I paid for it a couple years ago, why can't I get twice as much rent? Well, the simple truth is, just because you paid more doesn't mean some other tenant's willing to pay you more. So what happened was the ROIs just shrunk. So that cap rate or whatever, it just went down. Instead of getting 8, 10%, you were getting 4 or 5%. Well, what's happened is prices have collapsed. A recent REO assignment that I just got this week, it's about a $100,000 property, 3 bedrooms, 1,400 square foot house in the Southwest. A couple years ago, that was a $285,000 house. The rents on it were about $1,100. Today, the rents on it are maybe $1,050, and it's worth $100,000. So you can see that the rents on it only a little less, even though the value is a third. So, the sort of to answer the short-term question is, what does the long-term prospectus look like for rents if you're an investor? And it looks like it's gonna just kind of hang out. Is it going to drop a little? Probably. Is it going to drop 50%? No, that's highly unlikely. It is highly likely that the cap rates are going to be pretty good, and that your ROI will be pretty good, a lot better than it was a few years ago. Give you a good example. Your typical $60,000 house that you can buy, you can still get $900 a month rent for that. And even with some vacancy here and there, you're still looking at 10 to 15% of a return on your investment. That, assuming you're not buying in some place that has like an HOA where you're having to pay the HOA fees on top of that. So there are some opportunities. Really the biggest opportunity is to come into this marketplace, buying up $60,000 houses and really low-end houses as much as possible. Now, the average real estate agent's not going to tell you that. They're going to know, buy the $200,000 houses, because it's a ton of work to buy a dumpy little house, and there's almost no money in it for the agent. But here's a huge opportunity in it for the investor. These houses, when the market recovers, are going to be first ones to shoot up in price, because, if you think about it, a $60,000 house, an end user can buy that, get a loan for, maybe $400 a month, and buy that house easy. Anyone can qualify for that. So that tends to put upward pressure on values, which is what happened in the run-up. The bottom-end houses doubled and tripled in value. High-end houses didn't triple in value. So the idea is you buy up a whole bunch of those, and then you just cash flow them. You just basically either get a small loan on them, or you just pay cash for them and have a 10-12% return on your money, and at some point in the future these things double or triple in value, and you sell them. So that's sort of the opportunity that for investors right now in this marketplace. Do you have that opportunity in other marketplaces? Yeah. The difference is timeline. We don't know what the timeline is going to be here. We have more REO coming. There's still a lot of short sales, and is it going to be a 3-year recovery, a 5-year recovery, a 10-year recovery? Are values in the bottom end going to start coming up now a little bit? And maybe people have missed out. We don't know that. Only time will tell. But that's sort of my investment update for today. I thought I'd just give some general information about the Las Vegas market and some of the opportunities here. That's it. If you have any other questions, or I said something that kind of piqued your interest, comment box right below, just type something in there and I'll video respond to it. That's it for today, and have a great day. Thanks.